All right, welcome. Today, we are staging a showdown between two absolute giants of India's financial world: the Small Finance Bank, or SFB, and the Non-Banking Financial Company, the NBFC. Now, you might think they're pretty similar, but trust me, the way they're built and the rules they play by, they are worlds apart.
And that brings us to the big question, right? You've got these two very different types of lenders, both competing in this huge, growing market. So which one is actually set up for success? And maybe more importantly for you, which one holds the real key to unlocking growth in your portfolio? Okay, here's our game plan for today. We're going to start by meeting our two main players, the banker and the specialist. Then we'll dig into the rulebook that governs them, see how they turn those rules into a real advantage, check out the financial scoreboard, and wrap it all up with an investment playbook just for you.
So first things first, let's really get to know who we're talking about here. Yeah, on the surface, they both lend money, but underneath, their DNA, their whole reason for being is completely different.
So, first up, you've got the Small Finance Bank. You can think of this one as the new bank on the block. See, they were only created back in 2015, and they were given a very specific job: to bring banking to everyone, especially those who've been left out. They've got the full power and credibility of a real bank, but with a mission. And in the other corner, you have the NBFC. This is the seasoned specialist. These guys have been around for decades, since the 60s, and their game is all about focus and speed. They pick a niche, like lending for cars or consumer goods, and they absolutely dominate it, all because they have way more operational flexibility than a bank. Now, here's where things get really fascinating. The key difference isn't just what they do, but the very different rules they are forced to play by. This regulatory rulebook, it changes everything. It's not the same game at all. And you can see that trade-off crystal clear right here. On one hand, SFBs get this incredible advantage. They can take deposits from you and me. That's cheap, stable money. But there's a catch, a big one. They have to open a quarter of their branches in rural areas and lend a whopping 75% of their money to priority sectors. NBFCs, they get freedom. No branch rules, no lending targets. That gives them a massive operational edge.
And you know, this rulebook isn't set in stone, not at all. It's constantly changing. You can see how the whole landscape shifted when SFBs were born in 2015, and then again when the rules got tighter for NBFCs in 2021. And look ahead, 2025 could be another earthquake when some of these SFBs might just become full-blown universal banks. The game keeps evolving.
So, with these different sets of rules, how does each player actually try to win? Let's talk about their superpowers, the special strengths that come directly from their unique position in the market. The SFB's ultimate weapon, its superpower, is the deposit franchise. Being able to collect low-cost deposits from the public is a huge deal. Their funding costs are way lower than an NBFC's. This builds what the industry calls a liability franchise, basically a giant, stable pool of cheap money. Plus, that bank name builds a ton of trust. And here's what that superpower looks like in real numbers. For your typical SFB, a massive 70 to 80% of all its money comes from those sticky, low-cost customer deposits. That's not just an advantage, it's a fundamental game changer for how stable and profitable they can be. Okay, now for the NBFC. Its superpower is just pure, unadulterated flexibility. Think about it. No mandatory rural branches, no lending targets to hit. This frees them up to become absolute masters of a specific niche. They can move faster, make quicker decisions, and build super lean, digital-first businesses without all the heavy costs. And that flexibility, it goes straight to the bottom line. By being so lean and focused, some NBFCs run their operations at a cost that is, get this, 50 to 70% lower than a bank. That is a mind-blowing efficiency advantage. So, we've seen the playbooks, we've seen the superpowers. Now for the moment of truth. Let's put some hard numbers on the board and see how these two actually stack up on the financial scorecard. And what's really interesting here is that there's no single winner. It's a split decision.
SSBs clearly win on what's called net interest margin, and that's all thanks to their cheap funding. But NBFCs dominate on efficiency, that cost-to-income ratio is much better, and critically on return on equity, which is really the bottom line measure of profit for investors.
Yeah, just look at that gap in return on equity. It's pretty significant. While an SFB can give you a very solid 8 to 18% return, the nimble, efficient NBFC model can crank that dial way higher, often getting into that 12 to 25% range. If you're an investor chasing pure profitability, that's a difference that's pretty tough to ignore.
All right, let's bring it all home. We've met the players, we know the rules, and we've checked the scoreboard. So what does all this actually mean for you as an investor? How do you turn this knowledge into a smart strategy?
Well, it really boils down to this. What is your goal? Are you looking for stability, for steady income, for the comfort that comes with tight banking regulation? Then an SFB with its stable funding looks like a perfect core holding. But if you're hunting for higher growth, for bigger returns, and you're drawn to that agile specialist model, then an NBFC fits that growth holding profile perfectly.
But here's the final twist. This isn't really an either-or decision. The big takeaway is that these two are actually complementary. India's need for credit is so huge that there's more than enough room for both of these models to succeed. In a really smart, well-rounded portfolio, you could absolutely make a case for having both the stable banker and the agile specialist.
So there you have it. You've seen the playbook, you know the rules, the strategies, the results. You understand the fundamental choice, the stable, solid foundation of a bank, or the fast-moving, agile growth of a specialist. The game board is set. The only question left is, what's your next move going to be?